Over the past decade, investors have poured capital into Southeast Asia. Vietnam, in particular, has benefited.
They export a lot of final assembly of electronics, like some of your iPhones or your Samsung smartphones. They also export a lot of apparel.
President Trump's tariff plan could shake up this trade.
Vietnam is highly vulnerable.
Leaders around the world have asked the White House to back down from the tax hikes. In response, President Trump lowered tariff rates to 10% on most countries, except China.
I also have to say, 90-day pauses are not an eradication of tariff risk.
The tax hikes on products across Southeast Asia could be potent. U.S. imports of Vietnamese products grew rapidly in recent years. Experts say this may be connected to foul play from China.
Our analysis points to some tentative evidence of rerouting, particularly by Chinese firms that newly invested in Vietnam after 2018. If this can be definitively shown, countervailing measures against those particular exporters may be warranted.
What could these developments mean for producers in Vietnam and their customers in the United States? Factories in Vietnam produce many consumer goods sold in the U.S.
So Vietnam has become a second largest supplier of clothing and shoes to the U.S. after China. So major of American brands source heavily from Vietnam. For example, Nike, they produce about 50% of its footwear and 28% of its apparel in Vietnam.
Manufacturers in Vietnam produce furniture for companies like Wayfair and toys for companies like Hasbro and Mattel. Companies like Apple and Samsung also rely on Vietnam's manufacturing.
You know, Samsung alone employs 160,000 workers in Vietnam.
Between 2018 and today, more and more companies started actually investing anew in Vietnam. So Apple coordinated with a lot of its Taiwanese suppliers to move more production into Vietnam.
Businesses with supply chains that run through Vietnam saw their stocks sink as news of higher import taxes spread. If tariff rates proposed in April go into effect, they could cost around $3,800 for the average U.S. household. The U.S. has a much higher level of gross domestic product per capita when compared to Vietnam's.
There is simply a lot more demand in the United States for the kinds of things that Vietnam exports than there is demand in Vietnam for what the United States exports. And that's a function of the fact that the two economies are at very, very different levels of development. So the United States is an advanced economy. We tend to export goods that are capital intensive. Vietnam is a relatively poor country where demand for things like the new 787 is going to be much more limited.
The White House says that higher tariff rates will help the U.S. compete with rising powers like China. In recent years, businesses have reduced their production in China and ramped up in other developing countries, like Vietnam. This is known as the China Plus One strategy.
The way production works these days, pieces of a product come from all over the world and then are assembled together. But over the years, China had become the factory for the world. And so a lot of supply chains were entirely located inside China. So for example, an Apple iPhone, all the components would be produced and then finally assembled in China. But that became risky. And it became risky as Chinese wages started to go up, as people had concerns about too much dependence on a particular country. And so the insurance strategy was to open a factory in another country, say, for example, Vietnam or Thailand or Bangladesh or India.
One of the reasons that Vietnam has been on the come up, so to speak, has been because China has been so successful in its development model that it is pricing itself out of things like making t-shirts or sewing shoes and that kind of thing. They've moved on into kind of higher value added products.
China has been accused of using Vietnam to pass through some exports into the U.S. This tactic could help China avoid Trump's 2018 tariffs.
You saw a massive increase happening as a result of those 2018 tariffs. So one type of activity was what we like to call value-added production. So they were importing raw materials and intermediate products from China into a country like Vietnam or Thailand, and then doing the production in Vietnam and exporting. That was the vast majority of the activity, about 84% of the activity. But there's a smaller part, maybe 16%, depending how you measure it, which is rerouting. essentially relabeling products. So saying this is a product that was originally made in China, no new value added activity took place in Vietnam, and then it was exported as a Vietnamese product.
Economists say the higher tariff rates under discussion reflect trade deficits between the U.S. and other nations.
The relationship between the United States and Vietnam, the trade deficit is relatively sizable. It has grown in the last year to be about $123.5 billion.
The U.S. under Trump says that many countries are using unfair trade tactics like currency manipulation to expand their trade surpluses.
One of the things that the Vietnamese are considering is essentially revaluing their currency in response to the tariffs. Because if the tariffs are going to raise prices of Vietnamese producers so much that a decline in the currency is maybe the only option they have to compensate unless they can reach a settlement with the US government.
However, it's already low in 2024 already.
In April, a delegation from Vietnam reached out to the White House to strike a deal.
We've already seen Vietnamese Party General Secretary contact the U.S. administration, offering to potentially go down to zero tariffs on U.S. products entering Vietnam. The primary driver of this bilateral trade deficit that the United States has with Vietnam is not driven by tariffs or protectionism on Vietnam's part. It's driven by the fact that there's just relatively much more demand in the United States for Vietnamese products than there is demand in Vietnam for US products.
As tariff rates are negotiated, countries like Vietnam are bracing for impact.
People have called it like an unforced error or a self-inflicted wound, but it's worse than that because it's essentially like a suicide pact that's taking out large other countries along with the U.S. economy.
The White House did not respond to CNBC's request to participate in this story. In the year 2000, the U.S. and Vietnam signed a trade agreement which took tariff rates down from around 40% to 3%. Today, exports to the United States from Vietnam account for 30% of Vietnam's gross domestic product.
The outlook for the people of Vietnam, who, if we know anything about history in the last 50 years, have really been through the ringer, much of it at the hands of the United States, the outlook was very positive. Once you graduate into that lower middle income status and your manufacturing sector is taking off, this is a period in which that economic growth is translating into real household gains, so that the dirt floor becomes a cement or tile floor. The electricity is on 24 hours a day as opposed to maybe 8 or 12. That is a really heartbreaking point in economic development for the people of Vietnam to be looking at potentially taking a big step back from their first real taste of the kind of affluence that we in the West and the United States in particular often take for granted.